Before we dive in, please remember that I am not a licensed financial advisor or insurance agent. This video is for educational and informational purposes only. The information provided here is not a substitute for professional advice from a qualified expert who can assess your individual situation. Always consult with a licensed professional before making any financial or insurance decisions. You're driving home from work. It's a Tuesday. The light turns yellow, you slow down, but the car behind you doesn't. You hear the screech of tires, feel a violent jolt, and your world is a chaotic mess of shattered glass and deployed airbags. In the moments that follow after you realize you're okay, a single thought brings a wave of relief. I have insurance. I'm covered. But what if that relief is a lie? What if the policy you've been paying for every single month is a financial time bomb, waiting to detonate and destroy everything you've worked for? Because for millions of Americans, that is the terrifying reality. They believe they're protected, but they don't understand the single most important part of their policy: third-party liability coverage. This is the term insurance companies throw around, the one buried in the fine print, and it's the one that can either save you from financial ruin or be the very thing that pushes you into it. The confusion around this one concept is costing everyday people their homes, their savings, and their futures. And that is exactly what we are going to fix today. By the end of this video, you will not just understand what third-party liability insurance is. You will be an expert. You will know precisely what it covers, what it absolutely does not cover, and how to read your own policy to ensure you aren't one minor accident away from a lifetime of debt. This isn't just about car insurance. It's about financial survival. So let's start with the name itself. Third party. It sounds like legal jargon, but it's actually incredibly simple. In any insurance situation, there are three potential parties. The first party is you. You bought the policy, you pay the bills, you're the policyholder. The second party is your insurance company, the one you pay to take on the risk. So who is the third party? It's everyone else. Literally, the driver of the other car. Their passengers. The pedestrian on the sidewalk. The owner of the fence you crashed through. The city that owns the fire hydrant you just sheared off. Any person or entity that isn't you or your insurance company, who you cause harm or damage to, is the third party. And your third-party liability coverage is what pays them when an accident is your fault. This is a critical distinction. This coverage does not pay for your own car. It does not pay for your own medical bills. It is exclusively for the damage you do to other people and their property. Let's make this real. Imagine you're at a four-way stop. You think the other driver is waving you through, you pull out, and T-bone their car in the middle of the intersection. It's clearly your fault. The driver of the other car, let's call her Susan, has a broken arm. Her passenger, her son, has whiplash. Her car, a brand new minivan, is a total wreck. In this scenario, Susan and her son are the third party. Their wrecked minivan is third-party property. Your liability insurance is now on the hook for their nightmare. This is where your policy splits into two massive, critically important categories. The first is bodily injury liability, or BI. This is the part of your policy that covers people. It pays for the third party's medical expenses. And we're not talking about a box of Band-Aids. We're talking about ambulance rides, which can cost over $1,000. Emergency room visits, thousands more. X-rays, MRIs, surgeries, physical therapy, rehabilitation. The costs can become astronomical incredibly fast. But it doesn't stop there. Bodily injury liability also covers their lost wages. If Susan can't work for 3 months because of her broken arm, your insurance has to compensate her for that lost income. And then there's the biggest, most unpredictable cost of all, pain and suffering. This is compensation for the physical pain and emotional distress caused by the accident. This is where multi-million-dollar lawsuits are born. The second category is property damage liability, or PD. This is the part that covers stuff. It pays to repair or replace whatever you hit. In our scenario, it would pay for Susan's totaled minivan. But it also covers non-vehicle property. If you swerve to miss a deer and take out someone's prize-winning rose bushes and a custom-built brick mailbox, your property damage liability pays for that. If you slide on ice and crash into the front of a coffee shop, it pays to repair the building. And you have to understand, the cost of property damage has exploded in recent years. A simple fender bender isn't simple anymore. That bumper isn't just a piece of plastic. It's packed with sensors for parking assist, blind spot monitoring, and automatic emergency braking. A cracked headlight on a modern luxury car can cost $2,000 to replace because it's a sophisticated LED or laser system. The average new car price in the United States is now hovering around $50,000. Think about that. You could be one mistake away from being responsible for a $50,000 piece of machinery. Now, this is where the real danger lies for most people. It's what I call the state minimum trap. Every state requires you to carry a minimum amount of liability insurance to legally drive. And when people are shopping for insurance, they often see that state minimum option as the standard or good enough choice because it's the cheapest. This is one of the most dangerous financial mistakes you can possibly make. The state minimum is not a recommendation. It is the absolute lowest bare-bones level of coverage you can have without breaking the law. And in most states, it is terrifyingly inadequate. Let's look at a common example. Some states might have a property damage minimum of just $10,000 or $15,000. $10,000. Does that sound like enough to replace a car in today's market? What happens when you cause a chain reaction on the freeway and are responsible for damaging 3 other vehicles? What happens when you hit that brand new Ford F-150, the most popular vehicle in America, and total it? Its value is easily $60,000. Your insurance pays its limit, the first $10,000. Where does the other $50,000 come from? Comes from you. The other driver's insurance company will pay to fix their client's truck, and then their lawyers will come after you personally to get that money back. They will sue you. They will get a judgment against you. They can garnish your wages, put a lien on your house, and seize your assets. Your financial life can be completely upended for years, or even decades, all because you tried to save $20 a month on your insurance premium. The same goes for bodily injury. A state minimum might be $25,000 per person. One serious injury, one surgery, one helicopter life flight to a trauma center can obliterate that limit in a matter of hours, leaving you personally exposed to hundreds of thousands of dollars in medical bills and lawsuits. This isn't about scaring you. It's about empowering you with the truth. Understanding the concept of the third party is the first step. Recognizing that your liability coverage is the only thing standing between your life savings and someone else's losses is the second. It protects everything you have now and everything you hope to earn in the future. So now that we've established who the third party is and the 2 massive categories of coverage, bodily injury and property damage, we need to decode the numbers on your actual policy. What do those cryptic numbers like 25/50/25 or 100/300/100 actually mean? Understanding that is the key to unlocking whether you are truly protected or dangerously exposed. And that's exactly what we're breaking down next. Those numbers on your policy, the ones that look like a secret code, 25/50/25, they are the absolute heart of your third-party liability coverage. They represent 3 distinct promises your insurance company makes, and 3 very hard limits. Think of it like this. The first number is for injuries to any one person. The second number is the total for injuries for the entire accident. And the third number is for property damage. Per person, per accident, per property. Let's make this real. Imagine a guy named Mark. Mark is a good driver. He's never had an accident. He's trying to save money, so he calls his insurance agent and says, "Just give me the bare minimum the state requires." In many states, that's 25/50/25. It feels like a responsible choice. He's following the law, he's insured. He pays his premium and doesn't think about it again. One Tuesday afternoon, Mark is driving home from work. He's a little distracted, maybe thinking about a project, and for a split second, he glances down at his phone as a notification pops up. In that instant, traffic ahead of him stops suddenly. He looks up, slams on the brakes, but it's too late. He rear-ends a late-model Honda CR-V. It's not a horrific crash, but it's a solid hit. Mark gets out, his heart pounding. The other driver, a woman named Sarah, is shaken up and complaining of neck pain. Her husband, who was in the passenger seat, has a visible cut on his forehead from hitting the dashboard. The back of their car is crumpled. They exchange information, the police arrive, a report is filed, and an ambulance is called for Sarah and her husband as a precaution. Mark's car is damaged, but that's his problem. Remember, liability doesn't cover his car. He's just worried about the other people. He thinks, "Thank God I have insurance. They'll take care of it." This is where the numbers on his policy spring to life. A few weeks later, the calls and letters start coming. Let's look at Sarah, the driver. Her trip to the emergency room, the x-rays, the MRI to check for spinal damage, the diagnosis of severe whiplash, and the follow-up physical therapy appointments add up. Her total medical bill comes to $32,000. Mark has a 25/50/25 policy. That first number, 25, is the bodily injury liability limit per person. It means Mark's insurance will pay a maximum of $25,000 for any single person's injuries. Sarah's bill is $32,000. The insurance company writes a check for $25,000 and not a penny more. That's the hard limit. So where does the remaining $7,000 come from? Comes from Mark. Personally, Sarah's insurance company will pay her, and then their lawyers will come after Mark for that $7,000. He is now personally on the hook. But what about her husband? His injuries were less severe. His emergency room visit and stitches cost $10,000. This is where the second number on Mark's policy comes into play, the 50. This is the bodily injury liability limit per accident. It means the absolute most his insurance will pay for all injuries in the crash combined is $50,000. So let's do the math. The insurance company paid $25,000 for Sarah's injuries, hitting her per person cap. They then pay the full $10,000 for her husband's injuries, since that's below the per person cap. The total they've paid out for injuries is $25,000 plus $10,000, which equals $35,000. This is well under the $50,000 per accident limit, which is good, right? Well, yes and no. It's good that the total didn't exceed $50,000, but it doesn't change the fact that Mark is still personally liable for that $7,000 shortfall from Sarah's individual bill. That first number is a wall you can't get over no matter what the second number is. Now for the car itself. It's a relatively new Honda CR-V. The rear bumper is destroyed, the tailgate is crumpled, the taillights are smashed, and most importantly, the sensitive parking sensors and backup camera embedded in the bumper are toast. The repair estimate from a certified body shop comes back. With parts, labor, and paint, the total to fix the CR-V is $26,500. This is where the third number on Mark's 25/50/25 policy kicks in. The 25 at the end stands for property damage liability. His policy will pay a maximum of $25,000 to repair or replace any property he damages. The bill is $26,500. His insurance company writes a check for $25,000. That's the limit. The remaining $1,500? That's on Mark too. So let's tally up Mark's "I have insurance" moment. He owes $7,000 for the remainder of Sarah's medical bills, and he owes $1,500 for the remainder of the car repairs. He is now personally facing a bill for $8,500. And that's from a simple everyday low-speed rear-ender. For someone who chose minimum insurance to save maybe $20 or $30 a month, an $8,500 bill is a financial catastrophe. That's a debt that can lead to wage garnishment, where they take money directly from your paycheck. It can lead to a lien on your house. It can destroy your credit for years. And Mark got lucky. Think about the variables here. What if he hadn't hit a Honda CR-V? What if he had rear-ended a brand new Ford F-150? The average price of a new truck is over $60,000. If that truck is declared a total loss, Mark's $25,000 property damage limit is a drop in the bucket. He would be personally on the hook for over $35,000. What if he had hit a Tesla with its complex battery systems and specialized repairs? The bill could be even higher. What if he had caused a multi-car pileup, damaging 3 or 4 vehicles? His $25,000 limit would be exhausted on the first car, and he would be personally paying for every single other repair out of pocket. And what about the injuries? A simple whiplash claim exceeded the $25,000 limit. What if Sarah had needed surgery? A single spinal surgery can easily cost over $100,000. What if she had broken her arm and couldn't work for 6 months? Mark would also be liable for her lost wages, a cost that his insurance might not even cover depending on the policy specifics. Suddenly, that $25,000 per person limit looks terrifyingly small. A single moderate accident can generate medical bills that soar into the hundreds of thousands of dollars. When this happens, you don't just get a friendly bill in the mail. You get a thick envelope from the other party's insurance company's legal department. It's called a subrogation claim. It's a formal legal demand for the money they paid that you were responsible for. And they will not give up. They have teams of lawyers whose entire job is to collect this money. They will pursue you relentlessly because to them it's not personal, it's just business. To you, it's a life-altering nightmare that all started because you tried to save a few bucks and follow the minimum requirement. The state minimum isn't a recommendation for good coverage. It's the absolute lowest legal threshold you have to cross to not be driving illegally. It's designed to offer a tiny shred of protection, but in the reality of 2024 costs, With modern cars full of expensive tech and healthcare costs in the stratosphere, it's like trying to fight a house fire with a water pistol. Mark's story is a best-case scenario for a bad situation. Could have been so much worse. So that brings up the critical question. If 25/50/25 is so dangerous, what is safe? What happens in Mark's exact same accident if he had a slightly better policy like 50/100/50? Or the much more common 100/300/100 that many agents recommend? How much does that extra premium actually buy you in a real-world crisis? And is even that enough to protect everything you own? We're going to put those numbers to the test against this exact same crash, and the answer will show you precisely where the line is between being insured and being truly protected. So let's start with the absolute bare minimum, the legal requirement, the number that lets you drive off the lot without getting a ticket, but might as well be a paper shield in a sword fight. This is state minimum liability coverage. Now, this number changes from state to state, but a very common baseline you'll see is something like 25/50/25. It looks like a secret code, but it's brutally simple. The first number, 25, means your insurance will pay a maximum of $25,000 for bodily injury to a single person you hurt. The second number, 50, means your insurance will pay a maximum of $50,000 for bodily injury in total, for the entire accident no matter how many people you injure. And that last number, 25, is the maximum they'll pay for all property damage you cause. $25,000. That's it. That's the policy our driver, let's call him Alex, has in this scenario. He's paying the lowest possible premium because, hey, he's a safe driver, right? He just needed to be legal. Now let's rewind the clock to the moment after the crash. The sound of sirens is getting closer. The surgeon is clutching his wrist, staring at the crumpled hood of his $80,000 luxury sedan. The family is being checked over by paramedics, their $30,000 minivan a complete write-off. Alex, miraculously unhurt, stands by his own wrecked car, holding his 25/50/25 insurance card. He's insured. He's legal. He thinks he's covered. He is tragically, catastrophically wrong. Let's do the math, starting with the easiest part, the property damage. We have the surgeon's $80,000 car and the family's $30,000 minivan. The total bill to replace what Alex destroyed is $110,000. Alex looks at his insurance card. His property damage limit is $25,000. His insurance company will write a check for $25,000 and that's it. They have fulfilled their legal obligation. They are done. This leaves a remaining bill of $85,000. Where does that money come from? Comes from Alex. The surgeon's insurance company and the family's insurance company will pay to replace their clients' cars, and then their lawyers will turn around and come for Alex personally. They will sue him for the full $85,000. That's the first lawsuit. Before a single medical bill has even been looked at, Alex is already facing a debt that would cripple the average American household. We're talking wage garnishments, liens on his property, maybe even being forced to sell his home. And we are just getting started. Now for the part that creates million-dollar lawsuits, the bodily injury. Let's start with the surgeon. He has a clean break in his right wrist, his dominant hand. The trip to the emergency room, the x-rays, the specialist consultation, and the cast comes to about $5,000. Over the next few months, he'll need follow-up visits and intensive physical therapy. Let's add another $3,000, so $8,000 in medical bills. But that is the smallest part of his claim. This man is a surgeon. He performs delicate, intricate procedures with his hands. With a broken wrist, he is unable to work for, let's say, 8 weeks. If he earns $500,000 a year, that 8 weeks of missed work is $77,000 in lost income. So now his claim is up to $85,000. But we're still not done. The law allows you to sue for pain and suffering. For an injury like this, a common calculation is to multiply the medical bills by a factor of 1.5 to 5. Let's be conservative and call it 2. 2 times his $8,000 in medical bills is another $16,000. So the surgeon's total claim medical bills, lost income, pain and suffering, comes to $101,000. Now let's look at the family in the minivan. The father was driving. He has severe whiplash and a concussion. His medical bills for ER, MRIs and follow-ups are $10,000. He's an accountant and misses a month of work during tax season, costing him $8,000 in lost wages. His pain and suffering adds another $15,000. The father's total claim is $33,000. His wife in the passenger seat had it worse. She suffered a broken femur. requiring surgery with plates and screws. Her hospital stay, the surgery, and the months of grueling rehab total $40,000 in medical bills. She's a part-time teacher and misses the rest of the semester, losing $6,000 in income. Her injury is severe, life-altering, and will cause her pain for years. Her pain and suffering claim is $60,000. The mother's total claim is $106,000. The two kids in the back were thankfully just bruised and shaken. Their checkups and a few therapy sessions to deal with the trauma cost $5,000 total. So let's add it all up. The surgeon wants $101,000. The father wants $33,000. The mother wants $106,000. And the kids' claim is $5,000. The grand total for everyone injured in this crash is $245,000. Alex takes a deep breath and looks at his insurance card again. 25/50ths. $25,000 per person. $50,000 per accident. Let's see what that actually does. The surgeon's claim is $101,000. The insurance company can only pay him the per-person limit, which is $25,000. The surgeon's lawyer will laugh at that. The mother's claim is $106,000. The insurance company can only pay her $25,000. And the father's claim is $33,000. The insurance company can only pay him $0. Why $0? Because they've already paid $25,000 to the surgeon, and we're about to pay $25,000 to the mother. That adds up to $50,000. They have now hit the per-accident maximum. Their legal duty is done. They cannot pay another dime to the father, or to the kids. The insurance company, for which Alex has been paying his premiums, has contributed a grand total of $50,000 to a $245,000 problem. This is the moment Alex's life shatters. The remaining balance for the injuries is $195,000. Add that to the $85,000 he still owes for the cars. Alex, the guy who was just trying to be a safe, legally insured driver, is now personally on the hook for $280,000. This isn't a debt you can just work a little overtime to pay off. This is a life-destroying number. This is bankruptcy. This is losing your house, your car, your savings, your kids' college fund. This is having your wages garnished for the next 20 or 30 years, a huge chunk of every single paycheck you ever earn going to lawyers and insurance companies. He did the legal thing. He bought the insurance the state told him he needed. And in one single moment of distraction, that state minimum policy was so inadequate, it offered virtually zero protection. It was a financial placebo. It's a terrifying scenario. So what's the answer? More coverage, obviously. But how much more? Let's take Alex out of this nightmare and give him a much better policy. Let's say he was paying more and had what many would consider a very responsible, even premium level of coverage. $100,000 per person, $300,000 per accident, and $100,000 for property damage. 100/300/100. Compared to the state minimum, those numbers look enormous. A fortress of financial protection. Surely that would be enough to handle this exact same crash, right? $100,000 for the cars, $300,000 for the injuries. That has to be enough to make this whole problem go away. We're going to run the exact same numbers again with this new, much stronger policy. Will it be the silver bullet that saves Alex from ruin? Or will he discover that even inside that fortress, there's a trapdoor leading to a slightly smaller, but just as inescapable financial prison? Alex walks out of the insurance agent's office, a new policy document in his hand. Feels heavier, more substantial. He's no longer carrying the state minimum paper shield. This feels like steel. His new limits are $100,000, $300,000, $100,000. Spoken aloud, it sounds like an incantation of safety. $100,000 for bodily injury to any single person. $300,000 total for bodily injuries in a single accident. And $100,000 for property damage. Compared to his old policy, it's a financial fortress. He's paying more, of course, a significant amount more each month, but the peace of mind feels priceless. He gets in his car, the engine turns over, and for the first time in weeks, the simple act of driving doesn't feel like a high-stakes gamble with his entire future. But here's the thing about fortresses. They make you feel safe, but their true strength is only ever tested when they're under attack. And most people don't understand what the walls are actually made of. That $100,000 number for bodily injury? It's not just a pile of cash the insurance company hands over for hospital bills. It's a complex, multi-layered defense system covering things you've probably never even considered. Let's break down that wall brick by brick. The first and most obvious layer is medical expenses. This is what everyone thinks of: the ambulance ride, the emergency room visit, the surgery, the x-rays, the physical therapy. It's the direct, quantifiable cost of putting a person's body back together after an accident you caused. With a $100,000 limit, Alex can now imagine covering a pretty serious injury. A broken leg, a lengthy hospital stay without breaking a sweat. But right behind that is the second layer, one that catches so many people off guard: lost wages. If the person you hit, let's call her Sarah, is a freelance graphic designer, and her broken arm means she can't work her mouse for 3 months, your insurance is on the hook for that lost income. If she's a surgeon who can't perform operations for 6 months, you can see how that $100,000 limit starts to look less like a fortress and more like a garden fence. Your liability isn't just for their medical recovery, it's for their financial recovery too. And then there's the third layer. This is the one that's invisible, unpredictable, and has the power to turn a minor accident into a financial catastrophe. It's called pain and suffering. There's no bill for this. There's no invoice from a hospital. Pain and suffering is a monetary value assigned to the physical pain, the emotional distress, the anxiety, the sleepless nights, and the loss of enjoyment of life that Sarah experiences because of the accident. How do you put a price on someone's chronic back pain that prevents them from picking up their own child? Lawyers and insurance companies have formulas for this, often using the total medical bills as a base and applying a multiplier. A minor injury might be 1.5 times the medical bills. A severe, life-altering injury could be 5 times or more. This is the trapdoor Alex didn't know existed. He thought his new policy was a simple calculation. If the bills are under my limit, I'm safe. But he was about to learn that in the world of liability, the biggest bills are the ones that are never printed on paper. And there's one final, crucial piece to this puzzle: a benefit so huge it's almost criminal it's not the headline feature. Your liability coverage also pays for your legal defense. If Sarah decides to sue you, your insurance company doesn't just write a check and walk away. They are contractually obligated to hire lawyers, manage your defense, and fight for you in court, all on their dime, up to your policy limit. This alone can be worth tens, even hundreds of thousands of dollars. You're not just buying coverage, you're buying a legal team on retainer. So now let's rewind. Alex is driving home, feeling secure with his new 100/300/100 policy. That same intersection, that same momentary lapse in judgment. The screech of tires, the horrifying crunch of metal. This time, the other car is a 3-year-old SUV, worth about $35,000. Alex's new $100,000 property damage limit handles this with ease. He breathes a sigh of relief. One bullet dodged. The driver, Sarah, has a broken arm and severe whiplash. The ambulance comes, she goes to the hospital, she sees specialists. The total medical bills come to $27,500. Well under his $100,000 per person limit. Alex is feeling even better. His new fortress is holding strong. Sarah, the graphic designer, is out of work for 3 months, costing her $18,000 in lost income. The insurance company adds that to the tally. The total claim is now $45,500. Still less than half his limit. He's in the clear. He made the right choice. Then the letter arrives. Not from Sarah's insurance, but from her attorney. They are seeking compensation for her pain and suffering. They argue the constant pain, the trauma of the event, and the long-term impact on her quality of life are substantial. Their opening demand? They've taken her $27,500 in medical bills and applied a multiplier of 3, arriving at a figure of $82,500 for her suffering alone. Suddenly, the math changes. The total claim is no longer $45,000. It's the $45,500 in hard costs, plus the $82,500 for pain and suffering. The new grand total is $128,000. And just like that, the walls of Alex's fortress come crashing down. His $100,000 per person limit, the number that made him feel so safe, is now $28,000 short. His insurance company will pay out their maximum of $100,000, and their lawyers will fight to get the number down. But that remaining $28 grand? That's his. A bill delivered directly to his front door, courtesy of a trapdoor he never knew was there. He avoided the $500,000 catastrophe of his old policy, only to land in a new $28,000 nightmare. But the nightmare wasn't over, because Alex had forgotten one critical detail from the accident scene. Sarah wasn't alone in the car. Her husband, Mark, was in the passenger seat. His injuries were less severe, just some bruised ribs and a concussion. His medical bills were $15,000. He missed a month of work, costing him $5,000 in lost wages. His attorney, using the same logic, also sought pain and suffering damages, demanding another $45,000. Mark's total claim was $65,000. Now, Alex's policy has to perform a second test. Sarah's claim is capped at Alex's $100,000 per person limit. Mark's $65,000 claim is also below that per person limit. So, what's the total the insurance company has to deal with? They take the $100,000 for Sarah, plus the $65,000 for Mark. The total is $165,000. This is where that second number on Alex's policy, the $300,000 per accident limit, kicks in. Since $165,000 is less than $300,000, the policy covers it. The fortress, it seems, held up against the total siege. But one of the walls was breached. The insurance company pays its share, the lawyers settle, and the dust clears. And Alex is still left standing with a personal bill for $28,000, the amount that spilled over Sarah's individual limit. He thought he had bought a shield, but it turns out he just bought a smaller target. And now Sarah's lawyers, determined to collect that remaining $28,000, have started looking into Alex's life. They're not just looking at his bank account. They've discovered something about Alex he never thought would matter in a car accident: the value of his house. The fight isn't over an insurance payment anymore. It's about to become a battle for his entire future. You see, in the eyes of Sarah's attorney, Alex wasn't just a guy with a $50,000 insurance policy. He was a guy with a $50,000 insurance policy and a $400,000 asset: his house. In the world of personal injury law, this is called deep pockets. The insurance policy was just the appetizer. Alex's home equity was the main course. The lawyer had his paralegal run a simple public records search. They found the deed to Alex's house, its estimated market value, and the outstanding mortgage. They quickly calculated he had over $200,000 in equity. Suddenly, their target wasn't $50,000 anymore. It was $250,000, $250,000, $50,000 from the insurance company, and $200,000 from Alex personally. A week later, a thick cream-colored envelope arrived at Alex's house via certified mail. It wasn't from his insurance company. It was from the law firm representing Sarah. Inside was a document that made his blood run cold. It was a formal demand letter. The letter was polite, professional, and utterly terrifying. It detailed Sarah's injuries, the projected costs of her long-term care, her lost wages, and a number for pain and suffering that seemed plucked from thin air. The final number at the bottom of the page wasn't $150,000. It was $300,000. The letter stated that if Alex's insurance company did not tender the full policy limits of $50,000 within 30 days, and if Alex did not make arrangements to pay an additional $250,000, they would proceed with filing a lawsuit against him personally for the full amount, plus legal fees. Alex's hands were shaking. This had to be a mistake. A scare tactic. This is what insurance is for, right? He paid his premiums every month on time for years. He'd upheld his end of the bargain. Now they had to uphold theirs. He immediately called his insurance adjuster, the friendly-sounding guy named Mark he'd spoken to before. The friendliness was gone. Mark's tone was now cautious, measured. He'd received a copy of the same letter. "Alex," he said, "we are legally obligated to inform you of this demand. We will, of course, defend you against the claim. We've assigned an attorney to your case. However," and this was the word that changed everything, "however, our obligation is limited to your policy coverage. The $50,000. The demand is for an amount significantly in excess of your policy limit. We advise you to seek your own legal counsel to protect your personal assets." Alex felt the floor drop out from under him. "My own legal counsel? What are you talking about? You're my insurance company. You're supposed to handle this." Mark's voice was flat, devoid of emotion. "We will handle the claim up to $50,000. The attorney we provide works for us to defend our $50,000. They will also defend you, but their primary duty is to the company. If the judgment against you is more than your policy limit, you are personally responsible for the difference. The letter you'll be receiving from us is called an excess liability letter. It's a formality. It just puts all of this in writing. A formality. A piece of paper that told him his entire life savings, the home he and his wife had worked for 15 years to afford, was now on the line. The insurance company wasn't his shield anymore. They were a wall, but it was only $50,000 high, and the enemy was coming over the top with ladders. The lawyer they were providing wasn't his lawyer. He was the insurance company's lawyer. So what does personally responsible actually mean? It's a phrase we hear, but we don't truly comprehend the brutal mechanics of it until it's happening to us. It's not just a bill you get in the mail. It's a legal power granted to a creditor, in this case Sarah, to systematically dismantle your financial life until the debt is paid. First, there's the property lien. Sarah's lawyer, upon winning a judgment, could file a lien against Alex's house. A lien is like a legal post-it note stuck to your property title that says, IOWE. Alex wouldn't be forced to sell his house immediately, but the lien would just sit there, hovering. He couldn't sell the house without paying Sarah first. He couldn't refinance his mortgage. The equity he'd built, his nest egg, would be legally chained to this accident. It would belong to her. But they don't have to wait for you to sell your house. They can be much more aggressive. They can go after the money you haven't even earned yet. This is called wage garnishment. Sarah's lawyer could get a court order sent directly to Alex's employer. The order would legally require his company's payroll department to withhold a percentage of his paycheck, every single paycheck, and send it directly to Sarah's bank account. Imagine that. Working 40-50 hours a week, and seeing a quarter of your earnings vanish before you even see it, week after week, month after month, potentially for years, all to pay for a mistake that lasted 2 seconds. And then there's the most direct, most shocking tool of all. The bank account levy. This is exactly what it sounds like. With a court judgment in hand, the lawyer can find out where you bank. They can then send an order directly to your bank, legally compelling the bank to freeze your accounts. Checking, savings, it doesn't matter. The bank is then required to withdraw the money, up to the full amount of the judgment, and send it to Sarah. One day, Alex could go to the ATM and his card would be declined. He'd check his balance online and see a zero. Every dollar he had saved for emergencies, for his kids' education, for retirement gone, legally taken. This is the reality Alex was now facing. Every night he'd lay in bed staring at the ceiling doing the math. His salary, his wife's salary, their mortgage, their assets. He felt like a target. The life he had built felt like a fragile house of cards, and a single gust of wind was threatening to blow it all away. The stress was immense. It infected every part of his life. Conversations with his wife were strained. He was distracted at work. The joy was gone, replaced by a constant, gnawing anxiety. And then it happened. The 30 days from the demand letter expired. His insurance company had offered the full $50,000. It was rejected. 2 weeks later, there was a knock at the door. It was a man in a polo shirt holding a clipboard and an envelope. "Are you Alex Miller?" he asked. Alex nodded numbly. The man handed him the envelope. "You've been served." He opened it and there it was. A lawsuit. Sarah Johnson versus Alex Miller. His name right there in black and white on a legal summons. It was official. He was being sued for $300,000. The document ordered him to respond within 20 days, or face a default judgment. This was no longer a negotiation. This was a war. The insurance company's lawyer called him. He was a nice enough guy, but he was blunt. "Alex, my job is to try and settle this for under $50,000, or to defend the case in court. If we lose, and the jury awards more than 50, the company pays its 50 and walks away. You're on the hook for the rest. I can't give you personal financial advice. I can't represent your personal interests. I strongly recommend you hire your own attorney, an asset protection attorney." So now, on top of everything else, Alex had to go out and spend thousands of dollars of his own money to hire a second lawyer. A lawyer whose only job was to protect him from the catastrophic financial fallout that his own insurance policy was too small to cover. The insurance company's lawyer was there to protect their $50,000 investment. But who was there to protect Alex's $200,000 nest egg? Who was there to protect his future? He sat at his kitchen table, the lawsuit papers spread out before him, a symbol of his life spinning out of control. He picked up his phone, his finger hovering over the number of a lawyer his brother-in-law had recommended. He knew the single phone call would cost him a fortune, a retainer fee of $5,000, maybe $10,000 just to get started. A call that would lead to a meeting where a stranger would look at every dollar he'd ever earned and give him two terrible options: fight a long, expensive, and uncertain court battle, or find a way to pay a settlement that would cripple him financially for the next decade. There was no good way out. There was only damage control. And the damage was just beginning. Mark's first call wasn't to a lawyer. It was to his insurance agent, the same person who had sold him the state minimum policy a few years back. He remembered the conversation. He'd been trying to save money, get his monthly costs down. The agent had mentioned higher limits, but Mark, like so many of us, saw the bigger number and thought, what are the odds? He thought of insurance as a box to be checked, a legal requirement to be met, not a financial shield that might one day have to stop a cannonball. Now, that cannonball was mid-flight, and his shield felt like it was made of cardboard. The agent was sympathetic but firm. Mark, your policy covers you for $50,000 per person for bodily injury, up to $100,000 per accident, and $25,000 for property damage. We've already determined the other car is a total loss, so that $25,000 is gone. That's for their car. The real issue is the bodily injury claim. Mark's heart sank. So you'll pay them $50,000? And that's it. We have a duty to defend you, Mark, the agent explained. And this is a critical phrase you need to understand. Duty to defend. It means that when you are sued for a covered event, your insurance company has an obligation to provide and pay for a legal defense. They hire the lawyers. They manage the case. This sounds great, and in many ways it is. But there's a catch, a massive one. The lawyer they hire works for them, the insurance company. Their primary goal is to resolve the claim within your policy limits to protect the company's money, not necessarily to protect you from financial ruin beyond those limits. You are the client, but the insurance company is the one paying the bills and calling the shots. A few days later, Mark got a call from a lawyer, a man he'd never met, from a firm he'd never heard of, now tasked with defending his entire financial future. The lawyer was professional, but his tone was clinical. He wasn't there to hold Mark's hand. He was there to manage a file. The file just happened to be Mark's life. The first step was a process called discovery, and it felt exactly like that. It was as if the other side's legal team had been given a license to go on an archaeological dig through Mark's existence. They requested everything. 3 years of bank statements, his tax returns, his employment records. They subpoenaed his phone records to see if he was on a call at the time of the accident. They scoured his social media, looking for photos of him on vacation at a party, smiling, anything they could use to paint a picture of a man who was living a carefree life while their client was supposedly suffering. Every purchase he made with a credit card, every post he'd ever liked, every email he'd sent from his work account felt like it was being put under a microscope. It was a profound, unnerving violation of his privacy. He felt like a criminal, but he hadn't been charged with a crime. He'd made a mistake, a split-second error in judgment on the road. And now his life was an open book for a team of strangers whose only goal was to extract as much money from him as possible. Then came the deposition. Mark had to sit in a sterile conference room for 6 hours, a court reporter typing every word, while the other driver's attorney grilled him. The questions started with the accident. Mr. Peterson, did you check your blind spot? How fast were you going? Did you have your radio on? What were you thinking about just before the impact? But they quickly veered into the personal. How much is in your savings account, Mr. Peterson? What about your retirement, your 401k? Do you own your home? What's the equity? Have you ever been sued before? Have you ever even had a speeding ticket? He had to answer. Under oath. He felt his life being deconstructed, his assets being tallied up like items on an auction block. Meanwhile, the lawyer his insurance company had provided would occasionally object, citing legal procedure, but for the most part, he just sat there taking notes. This wasn't a fight for Mark's honor. It was a cold calculation of risk and exposure. As the weeks turned into months, the picture became clearer and grimmer. The other driver, the software engineer, was claiming severe, long-term back and neck injuries. He produced reports from a team of doctors, chiropractors, neurologists, pain management specialists, all detailing a litany of ailments that would require ongoing treatment, possibly for the rest of his life. They claimed he could no longer sit at a desk for 8 hours a day, that his promising career had been cut short. They weren't just suing for the medical bills he'd already incurred, which were approaching $80,000. They were suing for loss of future earnings, a number their experts calculated to be in the high six figures. The total demand in the lawsuit was for $950,000. Mark felt a numbness wash over him when he heard the number. $950,000. It wasn't a real number. It was a number from a movie, a lottery jackpot. He had about $12,000 in savings and a modest 401k. His house had some equity, but not that much. He was just a regular guy. How could he be on the hook for nearly $1 million? He was learning the brutal math of liability. His insurance policy, the one he thought was protecting him, had a $50,000 limit for this exact situation. So, the insurance company would be on the hook for $50,000. Mark would be personally on the hook for the other $900,000. This is the nightmare scenario. This is what it means to be underinsured. It's not just about not having enough to cover the other person's bills. It's about what happens when the legal machine gears up and targets everything you have, and everything you will ever have. Future wages can be garnished. Your assets can have liens placed on them. You can be forced into bankruptcy. The stress was relentless. It was all he thought about. At work, he would stare at his computer screen, his mind replaying the accident, rereading the threatening letters from the lawyers. At home, the tension was thick enough to cut with a knife. He and his wife argued about money, about the future, about a mistake that was now threatening to swallow them whole. He couldn't sleep. He lost weight. He felt a constant, grinding anxiety that followed him everywhere. The accident had lasted less than 2 seconds, but it was now dominating every second of his life. He started thinking about what he could have done differently, and not just on the road. He thought about that insurance renewal form. What if he had paid the extra $20 a month for higher limits? What if he'd opted for a $300,000 policy instead of a $50,000 one? That amount would have still been terrifying, but it would have given the lawyers a much bigger pot to negotiate with. It might have been enough to make the problem go away, to reach a settlement and let him and his family get on with their lives. An even bigger what if was something called an umbrella policy. For a few $100s a year, he could have added an extra $1 million or more of liability coverage on top of his auto and home insurance. $1 million safety net. The thought of it was agonizing. For the price of a few nice dinners out over the course of a year, he could have bought himself peace of mind. He could have been sleeping at night. Instead, he was lying awake, staring at the ceiling, wondering if he was going to lose his house. Finally, after nearly a year of this slow-motion torture, the call he had been dreading came. It was his lawyer, the one from the insurance company. His voice was flat, devoid of emotion. "Mark, we have a decision to make. The plaintiff's attorneys have made it clear they won't settle for anything near your policy limit. They believe they have a very strong case to take to a jury." Mark's throat went dry. "So what do we do?" There was a pause on the other end of the line. "Our position," the lawyer said, choosing his words with surgical precision, "is that we are prepared to offer them your full policy limit of $50,000 to settle the insurance company's portion of the claim. This is called tendering the limits." Mark didn't understand. "Okay. So we pay them the $50,000? "Yes," the lawyer said. "We pay them the $50,000, and in exchange, they will release the insurance company from any further obligation. Our duty to defend you would end. We would be out. The lawsuit against you for the remaining $900,000 would continue. You would have to hire and pay for your own attorney to take it from there. And that attorney is going to want a retainer. A big one. We're not talking a few $100s. For a case of this magnitude, where the stakes are nearly $1 million, you're looking at a retainer of $25,000, $50,000, maybe more. And that's just to get them to start working. That's just the down payment on a legal bill that will climb with every single phone call, every email, every document filed. Their hourly rate? $300, $500, $800 an hour. Or more. Suddenly, you're not just fighting a lawsuit. You're funding a war. A war you're likely to lose because remember, the facts of the case haven't changed. You were at fault. The damages are real. The other driver's life is permanently altered. The insurance company didn't walk away because they thought they could win. They walked away because they hit their contractual limit. They fulfilled their promise. Their very, very small promise. So you drain your savings account to pay the lawyer. You cash out your 401k, paying massive taxes and penalties. You borrow from family, straining relationships to their breaking point. You're liquidating your entire life not to pay the person you harmed, but just to pay for the process of being sued. And after months or even years of this agonizing, wallet-draining process, the inevitable happens. The judge's gavel comes down. A judgment is entered against you. For $900,000. Now, what does that piece of paper, that judgment, actually mean? It's not a bill. It's not a suggestion. It is a court order. It is a legal declaration that you owe this money, and it gives the person you injured, the plaintiff, extraordinary power to collect it from you. This is where the nightmare deepens. This is where it gets personal. The plaintiff's attorneys will now begin what's called post-judgment discovery. They will legally compel you to reveal every single financial asset you have. Bank accounts, investment accounts, real estate, vehicles, everything. Lying or hiding assets is a crime, perjury, with its own severe penalties. Once they have your financial blueprint, they start to dismantle it. First, they'll go after your bank accounts. They can get a court order called a levy and serve it to your bank. One morning you'll wake up, you'll go to use your debit card to buy a coffee, and it will be declined. You'll check your account online, and the balance will be zero. Every penny you had in checking and savings is gone, wiped out, sent to the plaintiff. No warning. Next, they'll come for your paycheck. This is called wage garnishment. They will serve a court order to your employer. And now, every single payday, before you even see the money, a huge chunk of it, often up to 25% of your disposable income, depending on your state's laws, is diverted directly to the plaintiff. Think about that. For every $4 you earn, $1 is taken from you before you can even use it to pay your rent, your mortgage, your car payment, or buy groceries. This isn't for a year or two. This will continue week after week, month after month, year after year, until that $900,000 debt, plus accumulating interest, is paid in full. At a typical salary, this could be the rest of your working life. You've been given a permanent financial handicap. But they're not done. Do you own a home? They will place a judgment lien on your property. This means you can't sell it, you can't refinance it, you can't take out a home equity loan without paying off the judgment first. The lien clouds the title, effectively holding your biggest asset hostage. In some states, depending on homestead exemption laws, they may even be able to force the sale of your home to satisfy the debt. The very roof over your family's head is now at risk. Do you have a brokerage account? Stocks you were saving for retirement? Gone. A boat you and your family enjoy on the weekends? They can seize it and auction it off. A second car? A valuable collection? Any non-essential, non-exempt asset is on the table. They will systematically strip you of everything you have worked for piece by painful piece. Your entire financial existence becomes a public record. This judgment is searchable. It will annihilate your credit score for a decade. Getting a loan for a car? Impossible. Qualifying for a mortgage? A fantasy. Renting a new apartment? Many landlords run credit and public record checks. They'll see a massive outstanding judgment and deny your application, viewing you as too high of a risk. You can become a financial pariah. Faced with this complete and total financial devastation, many people in this situation see only one way out: bankruptcy. Seems like a magic reset button, but it's not. Filing for bankruptcy is a deeply painful and humiliating process. You'll have to go before a trustee and a judge and declare to the world that you are financially insolvent. You'll list out every single thing you own, every dollar you owe, and subject your entire life to the scrutiny of the court. If you qualify for Chapter 7 bankruptcy, often called a liquidation bankruptcy, a trustee is appointed to gather up all of your non-exempt assets and sell them. That money is then distributed to your creditors. Your home might be safe if it's protected by a homestead exemption, but that second car, the investments, the savings, they're still likely to be liquidated. While the remaining portion of the $900,000 judgment might be discharged, you've essentially had to burn down your financial house to escape the debt. If you don't qualify for Chapter 7, you may be forced into a Chapter 13. This isn't a clean slate. This is a court-ordered repayment plan that lasts for 3 to 5 years. A trustee will control your finances, determining how much you can spend on necessities like food and housing, while every remaining dollar of your income goes to pay your debts. You lose your financial autonomy. You are, for all practical purposes, living on a strict allowance managed by the federal court system. And even after the bankruptcy is over, its ghost haunts you. It stays on your credit report for 7 to 10 years. It can make it harder to get a job, especially in fields like finance or positions that require a security clearance. It's a permanent mark, a public declaration of a catastrophic financial failure. And we haven't even talked about the human cost. The sleepless nights, the constant crushing stress, the arguments with your spouse about money because there is never, ever enough. The shame of telling your children you can't afford something, not because you're saving, but because your wages are being garnished. The impact on your physical and mental health. This single car accident, this one moment of distraction, this one decision to save a few dollars a month on car insurance, has now snowballed into a decade-long crisis that has destroyed your finances, strained your family, and altered the entire trajectory of your life. All because the liability limit on your insurance policy was a tiny fraction of the damage you caused. You thought you were insured. You thought you were protected. But you were only carrying enough insurance to protect the insurance company. You weren't carrying enough to protect yourself. So the question becomes, how is this even possible? Why would the law allow you to drive with a policy that offers such a terrifyingly low level of protection? Why are these state minimums so low that they practically guarantee financial ruin in a serious accident? The answer is shocking, and it reveals the true, misunderstood purpose of mandatory car insurance. It was never designed to protect you, the driver. It was designed for something else entirely. To understand this, we have to travel back in time. Back to the Roaring '20s. The automobile was new, exciting, and utterly terrifying. Roads were a chaotic free-for-all. There were no seatbelts, no traffic lights to speak of, and the rules of the road were more like friendly suggestions. And as cars started getting faster and more common, so did the accidents. Horrific, life-altering accidents. Imagine you're a shopkeeper in 1925. You've spent your life building your business. One afternoon, a driver loses control of his newfangled Ford Model T, plows through your storefront, and destroys everything. Your livelihood is gone. The driver, a young man with more confidence than cash, just dusts himself off, says, "Gosh, I'm awfully sorry," and walks away. He has no money, no assets. You can sue him, sure, and you might even win, but you can't get blood from a stone. Winning a lawsuit against someone with nothing means you get nothing. You are financially ruined, and there is absolutely nothing you can do about it. This exact scenario played out thousands of times across the country. Innocent people, the third parties, were being maimed, killed, and financially destroyed by drivers who had no ability to pay for the damage they caused. They were what lawyers called judgment-proof. The public outcry was deafening. This new technology, the automobile, was creating a societal crisis. The freedom of the open road for one person was becoming the financial death sentence for another. Governments realized they had to do something. But what? They couldn't just ban cars. The economic engine was already roaring to life. So they came up with a revolutionary idea, a concept that forms the very bedrock of the insurance you are legally required to buy today. The government didn't step in and say, "Drivers, you need to protect your own car and your own finances." No, they stepped in and said, "If you want the privilege of operating a 2-ton metal machine on public roads, a machine capable of leveling a building or ending a life, you must first prove that you have the financial ability to clean up your own mess. You must prove you can compensate the innocent people you might harm." This is the secret, the fundamental truth. Mandatory car insurance was never about protecting you, the driver, the first party. It was never about protecting your insurance company, the second party. It was created, from its very inception, to protect everyone else on the road from you. It was created to protect the third party. That's why the legal requirement is for third-party liability coverage. The law is concerned with your liability to others. It's a financial safety net, but it's not for you to fall into. It's a net stretched out to catch the victims you might create. The state is essentially forcing you to pre-fund a victim's compensation fund before they hand you the keys. And this is where the great, dangerous misunderstanding begins. People hear, "I'm required by law to have insurance," and they logically assume, "Therefore, the insurance I am required to have must be enough to protect me." Feels like a safe assumption. It feels like the government is looking out for you. But it's not. The government is looking out for the public from you. The state sets a minimum requirement, a floor, not a ceiling. And that floor is terrifyingly low. Let's look at the numbers. The numbers that create this illusion of safety. Many states have minimum liability limits that look something like this: 25/50/25. You've probably seen these numbers on your policy. What do they actually mean? The first number, 25, stands for $25,000. That is the absolute maximum your insurance company will pay for bodily injury to a single person you hit. One person, $25,000. Now, think about the cost of modern healthcare. An ambulance ride alone can be thousands of dollars. A single night in a hospital can be $5,000. An MRI? A couple thousand more. Surgery for a broken leg? You've just blown past that $25,000 limit before the physical therapy even begins. If that person you hit has a serious life-changing injury, that $25,000 is a single drop in an ocean of medical debt. The second number, 50, stands for $50,000. That's the maximum your policy will pay for bodily injury for the entire accident, no matter how many people you injure. So you swerved to miss a deer and hit a minivan carrying a family of 4. The father has a broken arm, the mother has a concussion, and the 2 kids have whiplash and need to be checked out at the ER. The total medical bills come to $90,000. Your insurance company will write a check for its legal maximum, $50,000, and distribute it among the family. What about the other $40,000? We'll get to that in a second. The third number, 25, is for property damage. $25,000. That's the maximum your insurance will pay for any property you destroy. This used to be fine when the average car was a Ford Pinto. But today, the average price of a new car in the United States is nearly $50,000. You cause a minor fender bender with a brand new Honda Pilot, and you've likely exceeded that $25,000 limit. What if you hit a Tesla, a Lexus, a new F-150 pickup truck? You could total a $60,000 vehicle. Your insurance pays the first $25,000. So what happens to the rest? What happens to the remaining medical bills in that minivan accident? What happens to the remaining cost of that totaled Lexus? This is the part they don't tell you at the DMV when you sign up for state minimum coverage. The insurance company has fulfilled its legal obligation. They paid out to your policy limits. Their job is done. Now the victim's insurance company, or their lawyers, turn their attention directly to you. They will come after you personally for the difference. And they will not stop. They can put a lien on your house. They can garnish your wages, taking money directly from your paycheck every single week for years, or even decades. They can seize your assets, draining your bank accounts, your retirement savings, your investments. Everything you have ever worked for, and everything you will work for in the future is on the table. This is the trap. The state minimum requirement gives you just enough rope to be legal, but not nearly enough to avoid hanging yourself financially. It allows you to drive, but it does virtually nothing to protect you from the devastating financial consequences of a single mistake, a single moment of bad luck. It protects the public by guaranteeing them a small initial payout, but it protects you from financial ruin about as well as a paper umbrella protects you from a hurricane. So if the state minimum is a trap, a financial landmine waiting to be stepped on, then what's the right answer? How much coverage do you actually need to be safe? Not just legal, but truly personally financially safe. The answer isn't just a simple number you can pick from a list. It's a strategy, and it depends on one critical factor that most people never, ever consider. That critical factor is your net worth. It's that simple and that profound. The amount of liability coverage you need is not determined by the state. It's not determined by your insurance company's prepackaged, good, better, best options. It's determined by what you have to lose. Think about it. Why do we even have liability insurance? It's not to protect the other person. That's a side effect. The primary, fundamental purpose of liability insurance is to protect you, to protect your assets, to protect your future. It's a shield that stands between a bad day on the road and financial ruin. When you cause an accident and the damages exceed your policy limits, the story doesn't just end there. The injured party's attorney doesn't just shrug and say, "Oh well, I guess that's all we can get." No, that's when their real work begins. They will launch a full-scale investigation into your financial life. They will look for your house, your savings accounts, your investment portfolios, your boats, your second properties. They're looking for everything you've worked for. And if they find it, they will come for it. This is the part that gets sanitized in the insurance commercials. They show a funny gecko or a quirky spokesperson, but they don't show the family that had to sell their home to pay a judgment. They don't show the person whose wages are being garnished for the next 20 years to cover the long-term medical care of someone they injured. This isn't a scare tactic. It is the cold, hard reality of civil law in the United States. Your state minimum coverage is designed to protect other drivers from small fender benders. It was never ever designed to protect your life savings from a serious lawsuit. So how do you figure out your number? You have to think like the attorney on the other side. You need to calculate what you're worth. Take a moment and do a rough inventory. Start with your assets. What's the equity in your home? That's the market value of your house minus what you still owe on the mortgage. What's in your savings and checking accounts? What about your investment accounts like a brokerage account? Add in the value of your vehicles, especially if they're paid off. Tally all of that up. Now subtract your liabilities. The mortgage itself, your car loans, student loans, credit card debt. Whatever is left over is your approximate net worth. That number, right there, is the absolute bare minimum target for your bodily injury liability coverage. If your net worth is $200,000, carrying $50,000 in coverage is like trying to stop a tidal wave with a screen door. You are leaving yourself exposed. The goal is to have enough insurance to make you an unattractive target for a lawsuit. Here's why. If you have, say, a $200,000 net worth and you carry 250/500 liability limits, and you cause an accident with $300,000 in damages, the other party's attorney sees that your insurance policy can cover the entire claim. They will almost certainly settle with your insurance company, take the check for $300,000, and you will never hear from them again. Your shield did its job. But if you have that same $200,000 net worth and only 50/100 limits, the attorney sees a very different picture. Your insurance pays out the $100,000 maximum, but there's still $200,000 left on the table. And guess what? They know you have it. They see your home equity, your savings. Suddenly, pursuing you personally, dragging you through depositions in court, becomes very, very profitable for them. You've made yourself the target. By saving a few dollars a month on your premium, you've put a giant bullseye on your entire financial life. And it gets even more serious. They don't just look at what you have now. They can also go after what you will have in the future. It's called wage garnishment. A court can order your employer to send a percentage of your paycheck directly to the person you injured, and this can go on for years, even decades. It's a financial prison sentence. Every promotion you get, every raise you earn, a piece of it will be sliced off the top to pay for a mistake you made 5, 10, 15 years ago. You aren't just protecting your current assets. You are protecting your future earning potential. You're protecting your ability to build wealth for the rest of your life. Okay, so what if you do the math and your net worth is $500,000 or $1 million or more? Getting an auto insurance policy with that much liability coverage can be incredibly expensive, if it's even offered. This is where the single most valuable and misunderstood tool in personal finance comes into play: the personal umbrella policy. An umbrella policy is exactly what it sounds like. It's a separate insurance policy that sits on top of your existing auto and homeowner's insurance. It's an extra massive layer of liability protection. It doesn't kick in until your primary insurance limits are completely exhausted. For example, let's say you have an auto policy with $250,000 in bodily injury liability, and you buy a $1 million umbrella policy. If you cause an accident with $750,000 in medical bills, your auto insurance would pay the first $250,000. Then your umbrella policy would kick in and pay the remaining $500,000. You pay your deductible and that's it. The entire catastrophic event is covered. Now here's the magic. Because umbrella policies only pay out on rare, catastrophic claims after the primary insurance has been maxed out, they are shockingly inexpensive. A $1 million umbrella policy can often be had for just a few $100s a year. Think about that. For less than the cost of a daily coffee, you can add $1 million force field around your assets. It's the single best bargain in the entire insurance industry. Most insurance companies will require you to have decent underlying limits on your auto and home policies before they'll sell you an umbrella. Typically something like $250/500/100 on your auto. This is a good thing. Forces you to build a solid foundation. Then, for a tiny additional cost, you add the skyscraper of protection on top. Let's make this real. Meet two neighbors, Mark and Dave. Both are 40 years old, have a family, a house, and a net worth of about $400,000. Mark has the state minimum insurance because he wants the lowest possible payment. Dave has a $250/500/100 auto policy, plus a $1 million umbrella policy. He pays about $40 more per month than Mark. One afternoon, Mark is momentarily distracted and runs a red light, causing a multi-car pileup that severely injures a neurosurgeon. The total medical bills and lost income for the surgeon come to $1.2 million. Mark's state minimum policy pays out its pathetic $50,000 limit. A lawsuit is filed, and Mark is now personally on the hook for $1.15 million. He loses everything: his home, his savings, his retirement. His wages are garnished for the foreseeable future. His life is financially destroyed. The next year, Dave has the exact same horrible luck. The same momentary distraction, the same accident, the same $1.2 million judgment. Dave calls his insurance agent. His auto policy pays the first $500,000. His umbrella policy pays the remaining $700,000. The lawsuit is settled. Dave's net worth, his house, his savings, his future, are all completely untouched. For the price of a few pizzas a month, he saved his family from total financial devastation. That is the power of a properly structured insurance plan. It's not about being legal. It's about being invincible. It's about building a fortress around the life you've worked so hard to create. So now you know the secret to protecting your assets from a liability lawsuit. But what about protecting yourself? What happens when the other driver is the one with no insurance or not enough? What about your own car? Getting liability right is half the battle. The other half is building a fortress around your own finances and your own health. And that's where the most confusing parts of your policy come into play. The most confusing parts of your policy come into play. Let's talk about the fortress. Let's talk about protecting you. Imagine this scenario. You're driving home, you stop at a red light. Out of nowhere, bam, you're rear-ended. The other driver is apologetic. They admit it's their fault. You exchange information. A week later, you get a call from their insurance company. And the news is bad. The driver who hit you, they only carried the state minimum liability coverage. Let's say it's $25,000 for property damage. But your car, your brand new SUV, has $40,000 in damage. It's a total loss. Their insurance company cuts you a check for $25,000, wishes you the best of luck, and that's it. They've fulfilled their legal obligation. You are now left with a $15,000 hole in your finances, a wrecked car, and the sickening realization that the other person's insurance wasn't enough to make you whole. This happens every single day. And it's why understanding the coverages that protect you and your property is just as important, if not more important, than the liability coverage that protects others. This is where we move beyond third-party coverage and into the world of first-party benefits. First, let's talk about your car itself. There are two primary coverages that protect your vehicle: collision and comprehensive. They sound similar, but they are worlds apart. Collision coverage is exactly what it sounds like. It pays to repair or replace your car if it's damaged in a collision with another object. This could be another car, a telephone pole, a guardrail, or even if you flip your vehicle. Crucially, collision coverage pays out regardless of who is at fault. Because the accident, it covers your car. If the other person causes the accident but they're uninsured or underinsured, like in our story, it covers your car. If it's a hit and run and you never find the other driver, your collision coverage steps in to fix your car. This is where your deductible comes in. A deductible is the amount of money you have to pay out of pocket before your insurance kicks in. A common deductible is $500 or $1,000. So if you have a $1,000 deductible and $10,000 in damage, you pay the first $1,000, and your insurance pays the remaining $9,000. A higher deductible typically means a lower premium, because you're agreeing to take on more of the initial financial risk. A lower deductible means a higher premium. Collision coverage is what allows you to get your car fixed or replaced quickly, without having to sue an uninsured driver and hope they have assets to collect from, which most of the time they don't. Then there's comprehensive coverage. This is sometimes called other than collision coverage, which is a great way to think about it. It covers damage to your vehicle from, well, almost everything else. Theft, vandalism, fire, hail, flooding, falling objects like a tree branch, or hitting an animal like a deer. If a hailstorm turns your car into a golf ball, that's comprehensive. If your car is stolen from your driveway, that's comprehensive. If you hit a deer on a country road, that's comprehensive. It's for all the random, unpredictable events that can damage your car when you're not even driving it. Like collision, it also has a deductible that you choose. For anyone with a car loan or a lease, both collision and comprehensive are almost always required by the lender. Why? Because the car isn't technically yours yet. It's their asset. They want to make sure their investment is protected no matter what happens to it. But even if you own your car outright, if you can't afford to write a check to replace it tomorrow without blinking, you need these coverages. Now let's move from your car to the most important thing, your health and your financial well-being. This is where the single most underrated and critical coverage on your entire policy lives. Uninsured and underinsured motorist coverage. Let's call it UM/UM. Remember our story about being rear-ended? The other driver was underinsured for your property damage. But what if you were injured? What if you had $50,000 in medical bills, but their bodily injury liability limit was only $25,000? You are in the exact same predicament, but now it's not about your car, it's about your health, your ability to work, your future. This is what uninsured and underinsured motorist bodily injury coverage is for. It is insurance you buy for yourself, to protect you from drivers who have no insurance or not enough insurance. If an uninsured driver hits you and puts you in the hospital, your UM coverage steps in and acts like the insurance they should have had. It pays for your medical bills, your lost wages, your pain and suffering, up to the limits you select. If an underinsured driver hits you, your UIM coverage kicks in after their low-limit policy is exhausted, covering the difference up to your own, higher limit. Let me be crystal clear. You should match your uninsured and underinsured motorist limits to your own bodily injury liability limits. If you have decided you need 250/500/100 coverage to protect your assets from others, you need to have that exact same level of protection for yourself. It is financial hypocrisy to do otherwise. You're essentially saying, my life and health are worth less than a stranger's. 1 in 8 drivers in the United States is uninsured. That's a terrifying statistic. UM/UIM is not a luxury. It is a shield against the irresponsibility of others. Finally, let's talk about the immediate aftermath of an accident. This is where medical payments coverage or MedPay and personal injury protection or PIP come in. They are similar but depend on what state you live in. MedPay is an optional coverage that pays for medical expenses for you and your passengers after an accident, regardless of who is at fault. It's designed to provide immediate funds for things like ambulance rides, emergency room visits, co-pays, and deductibles from your health insurance. It's relatively inexpensive and provides a quick, no-questions-asked payout to cover those initial bills, while the insurance companies figure out who is ultimately responsible for the crash. It can be a lifesaver, preventing you from having to pay for urgent care on a credit card. Personal injury protection, or PIP, is a broader coverage that is required in no-fault states. In a no-fault system, your own insurance company pays for your initial medical expenses up to a certain limit, regardless of who caused the accident. This is designed to speed up the payment process and reduce lawsuits. PIP is more comprehensive than MedPay. Not only does it cover medical bills, but it can also cover lost wages if you can't work, and even essential services you can no longer perform, like childcare or house cleaning. Even if you don't live in a no-fault state, PIP might be available as an optional add-on, and it is absolutely worth considering. People often ask, why do I need MedPay or PIP if I have good health insurance? It's a great question. The answer is threefold. First, your health insurance has deductibles and co-pays. MedPay and PIP can cover those costs. Second, health insurance doesn't cover lost wages or other non-medical expenses. PIP does. Third, and most importantly, health insurance doesn't cover your passengers. If you're driving with friends or family and get into an accident, your MedPay or PIP can cover their initial medical bills, which is a gesture of goodwill that can prevent some very uncomfortable situations down the road. So let's put it all together. The fortress. Your liability coverage is the outer wall, protecting the world from you and protecting your assets from the world. But inside that wall is everything you've built. Your collision and comprehensive coverage is the armor for your vehicle, ensuring you can stay on the road. And your uninsured/underinsured motorist and MedPay/PIP coverages are your personal bodyguards, protecting your health, your income, and your peace of mind from the vast number of people who are not as responsible as you are. Car insurance isn't just about satisfying a legal requirement to drive. That's the absolute lowest bar. True car insurance is a comprehensive financial plan. It is a tool you use to transfer catastrophic risk away from your family and onto an insurance company for a small, predictable fee. It's about ensuring that one bad day, one moment of distraction, yours or someone else's, doesn't unravel a lifetime of hard work. So here is your mission. I want you to go find your insurance policy declaration page. It might be in a glove box, a file cabinet, or online. Pull it up and look at it with new eyes. Don't just look at the price. Look at the numbers. Look at your liability limits. Look for the words uninsured motorist. Look for collision and comprehensive in their deductibles. Ask yourself, is this a policy designed just to be legal? Or is this a fortress designed to protect me? If you don't know, or if you don't like the answers you see, it's time to make a call to your agent or broker. It's time to ask the hard questions, because the time to find out you have a crack in your fortress is not after the attack has already begun. It's right now.